Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, here with Jeff Perry, both of us of Asset Management Resources. Thanks for being with us, and joining us for this segment, we've got my brother, attorney F. Keats Boyd III. Thanks for being here, Keats.
Thanks for having me again. It's nice to be here.
It's great to have you here. We got some interesting things to talk about. Jeff had pointed out that there's been a number of changes in Massachusetts law recently that's relevant. Certainly your area of expertise is affected by this.
Yeah.
So we thought this segment we'd talk a little bit about for our Massachusetts clientele and audience that are listening. What are some of the things that are relevant? And certainly the estate tax threshold is among those that we want to talk about. Jeff, before I throw it to Keats to jump in and chime in with all kinds of things, do you want to give us a little bit of a sense of the scope of what's been affected?
Oh, sure. Yeah, there was 6 parts of the tax law that was affected by some recent changes in the legislature signed by Governor Healy. And the most on-topic one that we'll talk about in a minute with Keats is the estate tax. But there were also changes to the senior circuit breaker, the child dependent credits, one that's important to our investors, Chris, short-term capital gains, rental deductions, and property tax reduction for volunteer services. So some changes incoming that are effective this year, right, Keats? They're already in effect. So
retroactive to January 1 in a few instances.
All right, let me guess. I'm going to go on a limb. I'm going to guess taxes are going up?
No.
Really?
Not necessarily.
No.
Depends on what you're talking about. In many cases, they're actually going down.
All right, good.
I know that Keats has been following the estate tax with obviously a keen interest.
I've been a dog with a bone on this one. Like you're not letting this one go, are you?
I am really interested. If you're, I know you're going to give a positive answer, but were you hoping for more? We'll start with that.
Definitely, yeah. If you've heard me talk, I'm, as an economics undergrad, that there was something I did my freshman year. One of the instructors taught about dead weight loss, and that just has had a major impact on my perspective of tax. Any tax is a bad thing for the economy. So this is an improvement. Before this legislation was passed, Massachusetts was the tied for the worst state in the country for estate taxes. After this, we're now the 3rd worst state in the country. It's an improvement. Could be better, but it's an improvement.
That's funny.
So, but it basically, it is going to make a big difference to a lot of families.
Massachusetts for nothing.
Right. So the general gist of the law is effectively the estate tax exemption is moved up to $2 million per person. Single people can pass $2 million estate tax free. Married couples could, with the right type of planning, pass up to $4 million estate tax free. So it's a big improvement versus half of those numbers. Up until we were planning on that up until October 4th when the legislation was signed. So it's a big improvement. We still have
and just as an aside, these days it doesn't take much with a house and a retirement plan or something. You can bump into that $1 million threshold. As much as we all think $1 million is a lot of money, and it is, lots of people hit that threshold
very
more so
easily
than probably when that was originally
intended. A lot of people who are going to say, yeah, I own my home, but I've got this huge mortgage. I don't have a lot in my retirement account yet.
Yeah.
But if they have a life insurance policy,
there you go.
They can very easily be subject to an estate tax if they,
who doesn't need $1 million of insurance?
Exactly.
Trying to replace income, pay off some debt.
Exactly. So, it's going to help those families out a lot.
Small business owners too, right? I mean, they really get caught in this.
Absolutely. This is something that, going to help a lot of families. The way that the new law is structuring the increase in the exemption, it's really, we've kept the law basically the same. If you've got up to $1 million, you must file an estate. I'm sorry, if you're over $1 million, you must file an estate tax return. If you have up to but less than $2 million, you're allowed to take a credit on the tax due on the amount between $1 and $2 million. So, basically, if your estate size were 2 million, the tax would be 99,000. I'm sorry. $99,600 or something like that.
Mm-hmm.
And the credit will wipe out that tax. So it's a way of getting there, but you still have a filing requirement. So there's still going to be some work for estates over $1 million. They will be required to file this return. They won't have to pay any tax. Estates under $1 million will still be able to get a lien release for their homes or other real estate located in Massachusetts by filing an affidavit. But if they're over $1 million, they're going to need to file the estate tax return and get a lien release issued by the Department of Revenue. So I think, too, what's interesting with this is this credit seems to work more favorably for out-of-state residents in that the credit is a fixed dollar amount. And out-of-state residents, the way the estate tax is calculated, we pretend for a moment that the out-of-state resident is a Massachusetts resident who happens to own some real estate or has some personal property located in Massachusetts. We calculate what the tax would be here in the state if they lived here. Then we remember they're not really a Mass resident, but they're just an out-of-state resident who owns some property here. So what we do is we take a ratio, put together a fraction with
what percentage of
the Massachusetts property over the total estate size and multiply that by the tax the Mass resident would pay.
Mm-hmm.
That result is what the Florida or out-of-state resident would have to pay a tax on. Now we get to apply the credit against that number is how I read the statute. Now, I don't know that DOR is going to agree with me. We have to see what they ultimately do. We've had a lot of people, because this is a retroactive tax change to January 1 of 2023, we have a lot of clients who we've put on extension. So we've got to wait and see what DOR does with how they're going to apply some of these changes and what thoughts they're going to have as to whether or not that credit will apply only to the tax the Mass resident would pay, or if it's the tax that the Florida or out-of-state resident would pay. So it's going to be interesting to see DOR's take on this.
If someone moved during the year, they're saying?
No, I'm saying if they died this year as an out-of-state resident, but they have a second home here on the Cape or somewhere in Massachusetts, where will the credit be applied to the tax that
at
would
the
have
time
been
of
paid?
Death, or
no? I mean, so the tax is going to be at the time of death. It's a question of when we calculate for the out-of-state resident. There's two places where we come up with a number. The first number is pretend they're a Massachusetts resident. And we come up with what the tax would be for the Mass resident. Do we apply the credit then? Or do we apply the credit after we adjust for the fact that they only have a small percentage of their estate located in Massachusetts?
More of their estate would be exempt.
Right.
Essentially.
Right. So, the way the statute's written, in my reading of it, we apply it as the last step. Once we know what the tax is, then we apply the credit. DOR may read it, no, we apply it earlier in the process, and they may still have a tax. So we got to see how that plays out. But there's, it generally is going to be an improvement for everybody, reducing the estate tax. And that really, again, puts planning into a major shift, I think. Historically, estate planners have been looking at what's the estate tax consequence to the client. We got to plan for estate because that's the important tax to plan against. That's not really been the case for, I don't know, maybe 10 years. It's really the income tax that we need to be looking at.
How to plan around that. And maybe you want to elaborate what you mean by that.
All right. So very often it really
sounds straightforward, but I think there's some complexities there.
So when you're looking at someone's estate, there's two considerations, and a lot of it relates to capital gains tax and step up in cost basis. If we buy a stock, we pay $10 for it. Over time, it appreciates to $100. If we sell it, we have to pay a capital gains tax on the appreciation, the $90 of growth.
Yep.
If we hold that stock until we die, we get to change the cost basis from the 10 we paid for it to the $100 it's worth on the date of death. That makes the capital gains tax go away. All right.
Yep.
So if we own something at our death, we're eligible to take that step up in basis. If we say, oh, estate tax is still the most important tax, make it so that somebody doesn't own something at their death. So we save the estate tax. Well, we're going to lose the step up in cost base.
Yeah, they're competing, right?
Exactly. So we have to really look at each estate to say, well, which tax is going to be the bigger tax? Is it going to be the estate tax, or is it going to be the income tax consequence of not having a step up in basis?
Yeah.
And so the calculus is changing so that for many families, the bigger tax is the capital gains tax. And so we're using
better off
techniques.
retaining the wealth, and
That's right. Yeah, it's very often cheaper for your kids, for your estate, to pay a small estate tax to Massachusetts so that the kids can get the benefit of a step up in basis.
Now we know that income tax law changes with the expiration of
Right.
the Tax Cut and Jobs Act.
Right.
in
25, right?
At the end of
25 it ends.
2025, beginning of 2026, the new rates go into effect.
Are there any implications for estate thresholds at that time?
Big implications there. Yeah.
Yeah.
The federal estate tax right now is $12.92 million per person. Married couples can effectively double that, again, with proper planning.
Yeah.
The estate tax exemption in 2026 will revert back to $5 million,
Yes, at 5.
indexed for inflation from 2010 to 2026.
Maybe
Best
6,
guess
7.
around $6 million.
Yeah.
So, it's going to be a reduction in exemption. But for most families, it's still going to make estate taxes irrelevant. You know, it's not going to be a big deal for too many families because, again, for married couples, they have twice that.
Yeah.
And at the federal level, for deaths that happen between now and January 1 of 2026, you can take advantage of portability to preserve the large exemption of a spouse who dies between now and then. And families that don't have a death, that can't have the opportunity to take advantage of portability, they can do planning and give away as much as they want to avoid federal estate tax.
You mentioned portability. Is that a concept that applies in Massachusetts as well?
No, portability is only available at the federal level. It's available in Maryland, and I believe there's one other state. It's either Michigan or Minnesota. I've forgotten which one.
One of those MI ones.
Yeah, right. Up in the lakes, those Great Lakes area, right? Somewhere up there.
Just kidding.
Right.
Okay. Yeah.
But portability, just to give a quick overview, is the idea that says if one spouse dies with an exemption and they can't use all of the exemption, you can port or move the exemption from the deceased spouse over to a surviving spouse.
So the rest of it goes to the survivor.
Right. So, for example, if I had an estate of $1.92 million and I've got a $12.92 million exemption, well, I can port the $11 million I can't use over to my spouse, and when she passes, she'll have her exemption plus my exemption.
Okay.
So when the exemption goes down, she'd only have $6 million, but she'd still have my $11 million on top of that. So if she won that scratch ticket, she'd have no estate tax. But that's an important consideration too, because it's there are some people who'll be impacted by it. So planning for them between now and 2026 is going to be important. Using up some of that exemption before it disappears can be critical for large estates.
So before we go on to talk about some of the other tax, implications for changes, when it comes to an estate plan, I've done my estate plan a year or two ago, maybe, let's say.
Yeah.
So recently, let's call it. What do I need to think about? Does this create complexity, or do I have to change something, or does it leave me in a position where I'm okay?
Unfortunately, I have to give the it depends answer.
Yeah,
maybe.
Yeah. So I would say that if you're working, if you're married and you have an estate plan that has a revocable trust for one spouse and a different revocable trust for the other spouse, then yes, you absolutely should revisit your plan.
It. So if you're a little bit older in the plan type of thing, the way that we used to do it kind of thing.
Yeah, that's what we used to use up until about 2012, and we've shifted away from that to one joint trust.
Okay.
And the thing is, what you're doing with two separate trusts is you are determining that you are going to plan for estate taxes.
Yeah.
Even if income taxes are the bigger tax, you're stuck with planning for estate taxes. And very often families doing that, the strategy was put half the estate into one trust and put the other half of the estate into the other trust. Of course, you don't use retirement accounts for that, but everything else would go into the two trusts. You're very likely overfunding the exemption of the first to die, meaning they're going to be setting aside too much money that doesn't belong to the surviving spouse and will not be eligible for a step up in basis. So for example, if you have a family with a two trust system and they have a net worth of $1.5 million, they don't need to do a tax shelter under the current estate tax law.
Yeah.
But their plan is going to force them to create a credit shelter trust, have a separate income tax return for that credit shelter trust. It doesn't belong to the surviving spouse. It will not be eligible for a step up in basis. And the kids may end up paying more in capital gains tax than they need to.
Yeah. One of the things that I love about the way your plans work now is that, unfortunately, spouses don't necessarily die at the same time in most instances.
Right.
For most spouses would probably prefer that, but it's not the way it works typically. So when there does have that kind of circumstance where one spouse passes, all of the assets can be eligible for a step up in basis.
Yeah.
Which is huge especially for a surviving widower, when it comes to legacy assets that can be now reimagined of whether we want to retain them or adjust the structure of the portfolio, because some of these things can be legacy from a long time ago.
Right.
And
it can be, you inherited
consequences.
stock from your parents when they died. And you kept the position.
Right.
And now it's appreciated and you can't dare sell it because of the capital gains tax.
Yeah. Most people are hesitant to take the hit.
Your parents left you the stock, but your spouse died. We have a technique where that will give a step up in basis to the spouse who inherited the stock.
Which is fabulous because it gives them the flexibility now to say, oh, I can translate this into something that'll generate more cash flow, or I can sell some because I need to use some of the principal or whatever it is.
You know what? It's often
you got that
something even more basic than that.
Yeah. We
live here. The kids live there. I'm all alone. I'd like to sell the house and move closer to the kids.
Perfect example.
If you use a two trust approach,
yeah,
you might get a 50% step up in basis, but you can still have a capital gains tax, even though you've got the $250,000 capital gains tax exemption on the sale of a primary residence.
Right.
The approach that says one trust for the couple with a technique to get step up in basis on everything when the first spouse dies can make it so that the surviving spouse can sell the home, move closer to the kids, and have that security that they won't have without risking a large tax consequence.
And just while we're talking about it, as we're talking about the estate planning considerations, for people who want to learn more, you can learn more about Keats and his firm at boydandboydpc.com. It's spelled out every letter of the whole thing.
Right. And up near the top of our page, there's a seminars page. And actually, as you log into the first page, there's an opportunity to take a seminar if you want to do it online. But there's also our seminars page that you can go to. And we go into the details of how these.
A lot of explanation, very educational in nature. And if you're thinking this maybe applies to your situation, or do I have the right plan for my needs? Either check it out online or come to one of their upcoming events.
If I can just go into one more thing, do we have to take a break?
No. I was going to look to talk about some of the other aspects of the.
I just, I was doing a quick take. After we did we had this estate tax change. I went back and looked over the last 20 years. There have been 24 important changes in the law, regulatory changes or case law changes that have occurred over the last 20 years.
Wow.
Is that all?
Yeah. Right. So what does that mean to the person out there who does their estate plan and says, great, it's all done. I'm sticking it up on the shelf.
I'm going to do it today. Right.
Dust it off and say, well, maybe I should look at this.
Yeah. What it means is you really need to be reviewing your plan annually, where we really need to be looking at it different. It's not a once and done. Planning is a process. You know that.
Yeah.
Whether it's a financial plan or estate plan. it's a process, and you got to continue to pay attention to it all the time. And sometimes it's tweaking by changing who your important fiduciaries are, your executor, personal
Sure.
representative, your trustee. Sometimes it's tweaking for the technicalities of it. But it needs to be reviewed. You need to make sure that you have your assets owned by your trust, that your statements are coming out. I met with somebody just the other day, and it looked like they thought their things were in their trust, but the reality was they had a bunch of beneficiary designations that named the trust, and that really didn't cut it for step up in basis and all these other things. So you got to make sure that you're doing it right. You need to reach out to your planner and make sure that they're helping you through that process.
So good prompt. Don't delay. Dust it off. It's time to review. Yeah. This is one of those occasions.
Don't put it away. Keep it out. Review it regularly.
Yeah. Jeff, let's and Keats, let's just touch on some of the other items with the 2 or 3 minutes we got here. What are some of the other quick things that we can mention about the change in the law? You mentioned the short-term capital gains rate.
I did. Right now, the short-term rate is 12%, which is a bit onerous. So they're reducing it to 8.5%, which brings Massachusetts more in line with some other states. Not Florida, by the way. I'm just saying. Not Florida. It's still 0.
Yeah. Says the guy
it's hard to beat 0.
Says the Florida resident. Yep.
Yeah. But they do keep the short-term rate on collectibles like gold at 12%. So there are some folks that will still be subject to a 12% short-term capital gain.
I wonder where it
seems a bit unfair.
So that, is that considered
that's a good question. I don't know how DOR would take a position on that.
But anyway, just as an aside.
Related to that, we've got the millionaire's tax that was passed in Massachusetts by referendum a little while ago. I think it's interesting that if you had a short-term gain that would put you into the millionaire's tax, the effective tax after the millionaire's tax is going to be really close to what it was before. So in effect, there's not a big change here. The millionaire's tax is an additional 4% on anything over $1 million. And so that would effectively make your short-term capital gains rate 12.5%. So just an interesting aside.
Yeah, thanks. That makes my day.
Right.
Just one of those things when you think about this stuff, it's millionaire's tax make it sound like, oh, that doesn't apply to most people.
People are going to get bit in the backside by this. This is one of the stupidest tax I've ever read. B, one of the most avoidable taxes I've ever seen for most individuals. It's so easy to take a couple of steps to make this tax go away. It just requires a little bit of advanced planning. They did in this legislation take away one of the techniques that, or at least starting in 2024, they took it away. One thought was, if you're married, file a married filing separate return at the state level. Now, you can still file married filing jointly federally, which tends to be more advantageous. But for 2023, you can file married filing separately, and that effectively gives each spouse a $1 million exemption for the millionaire's tax.
In some cases that might work, right?
Yeah, in some cases that may help. But that technique will go away starting in 2024. Whatever you file federally, you're required to file in Massachusetts the same technique.
Status.
Right.
All right. Well, very good. Probably more to discuss, but we're running out of time. Thanks for coming in to talk about this. Jeff, we can always revisit this in future episodes.
We should save it for another podcast. Absolutely.
All right. Well, again, thanks for being with us. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.